Welcome to the Startup Espresso. I'm Hall T. Martin, the host of the show, where we talk about raising funding for your startup and the time it takes to have an espresso. I hope you enjoy this episode. Hello, this is Hall T. Martin with the Startup Funding Espresso, your daily shot of startup funding and investing. There are several methods for calculating the valuation of a company for an M&A deal. Here are some key methods to consider. Multiples of revenue or earnings. Each industry segment has a commonly used multiple based on revenue or earnings for valuing the company. To calculate, take several recent exits of businesses in the same industry and calculate the multiple. Comps. This stands for comparables and uses exits from similar companies to calculate the valuation. Calculate, identify 5 companies that have the same revenue, growth rate, and monetization model and calculate the exit valuation. Cost to replace. This calculates what it would cost to replace the business you are selling. To calculate, identify the cost of development, marketing, and sales to build a company to the size you have. Discounted cash flows. This uses the future cash flows from the business and discounting back to today. To calculate, make a 10-year financial projection of revenues based on current growth rate and apply a discount rate to set the valuation. Calculate your valuation using all of these methods to determine which one puts your business in the best light. Thank you for joining us for the Startup Funding Espresso, where we help startups and investors connect for funding. Let's go start listening to today. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.